Hi there, welcome to Kneppy Invest. It wasn't that long ago that an acquaintance of mine asked me some companies that had a fairly low PE ratio. And the reason this person asked me for some companies with a low PE ratio, they thought that meant these companies are really cheap, really good value, and they're a must buy. But a really low PE ratio doesn't necessarily mean a company is cheap. And in fact, today's video, I'm going to be talking about Bluescope Steel's financial year 22 results. And based off their financial year 22 results, it gives this company a P ratio of 2.7. So you'll probably be jumping out of your skin saying, this company is awfully cheap. I'm going to have to go out and buy it, but that's not true. So P ratios can be misleading. So just don't look at a P ratio in itself, in isolation, and make an investing decision based off that. Now, in saying all that, and saying that Bluescope Steel is not cheap at current valuations, I do have a soft spot for this company. In fact, Bluescope Steel and South 32 were the first two companies that I tested a new investing strategy, and it worked wonders. So I made a fair bit of money out of Bluescope Steel and South 32. So both of these companies have a special place in my heart simply because of that. So I'm always keen to see how Bluescope does perform. And it was a bit of a shock to see their financial year 22 results and then see or notice that they have a PE ratio of 2.7. Now, I'm really liking doing these financial year 22 videos. And one of the reasons I really like doing these videos is because I'm learning a lot about some companies I probably would have not done any research on. And the next 5 companies I'm going to be doing a video on in this series include NextDC, Imdex, High Tech, and those 3 companies I have done very little research in the past. So I'm looking forward to finding out if these companies are a possible buy in my long-term portfolio. So if I think they're high-quality companies, I might buy these companies for the long term. And the other 2 companies I'll be doing a video on in the next 2 weeks include IPD Group and PWR. I know a little bit more about those 2 companies. In fact, I really like PWR, Advanced Cooling Technologies. And even though I'm not a shareholder at this point in time, I'd love to be a shareholder. And I'm just waiting for the share price to see have a significant pullback. And the other company, IPD Group, is a newly listed company on the ASX. And the chart for that company looks absolutely amazing at this point in time. And I am a shareholder because that company keeps on releasing profit upgrades. And if they keep on releasing profit upgrades, I'm going to remain a shareholder of that company. Whenever I do research on a company, the first thing I want to know about that company is whether the quality of Bluescope or that company I'm doing research on is high or low quality, because the way I treat those companies depends on the quality spectrum. So if I think Bluescope Steel is a high quality company, it's all around a value. And right now, a P ratio of 2.7, if Bluescope Steel was a high quality company, this would be a screaming buy. So of course, because I've already said it's not value with a PE ratio of 2.7, that must mean I consider Bluescope Steel to be a low quality company. And that's absolutely true, in my opinion, because Bluescope Steel is just like a mining company. They are a price taker. So they still sell steel, and they don't really have a say on how much they sell their steel for. When steel prices are really high, they will benefit from it. And when steel prices are really low, they will have the complete opposite effect of benefiting from it. And in fact, the whole reason why the P ratio of Bluescope Steel is 2.7 is because steel prices were really high for the first half of financial year 22. And I'll show you some of the slides they actually used in their presentation. And those tailwinds looks like they are coming to an end because steel prices are falling back. So Bluescope Steel is a low quality company. But just because it's a low quality company doesn't mean I won't ever own this company. If I see the share price moving up in an uptrend, if I see positive sentiment behind this company, I will take a short to medium term position in this company. And that's exactly what I did in the middle of 2020. I took a position, only for the short to medium term because the share price was moving up. And I held on to these shares until the uptrend came to an end. So I have sold out of Bluescope Steel, locked in my profits. And that's what I do with these low quality companies. It's all about the share price trend. It's all about the sentiment in the company, nothing to do with the value. Because right now, PE ratio for Bluescope Steel is 2.7. It might seem like there's some value. So the value or the perceived value can be deceiving because, well, Bluescope Steel in this example is a perfect example that PE ratio can be deceiving. Now onto the long-term chart for Bluescope. So I like to look at the long-term chart for every company I'm doing research on, because sometimes you can get a little bit of an opinion or thought, particularly if you're not sure about the quality of the company, by just looking at the long-term chart. So if you just look at the Bluescope long-term chart, you might think maybe this is a high quality company because the share price has gone from the bottom left to the top right. And that's exactly what you want in a high quality company. You don't want to see any significant drop in the share price during a period of time in the last 10 years. And to be fair with you, there hasn't been any significant drop in the share price. So just based off this 10-year chart for Bluescope, you probably could start an argument that this company is high quality. But once you look at the longer term chart, I think your opinion might change. And this is the longer term chart. So this is the monthly chart of Bluescope Steel going. I don't know why I'm finding it really hard to say Bluescope Steel. Bluescope Steel. Anyway, this is the monthly chart going back to 2002. So 20-year chart. And right now the share price is hovering around about $16. Share price high quite a few months ago was around $26. And you can see that was a multi-year high. So almost we'll say about a 12-year high. But if we go back to 2007, the share price of Bluescope Steel reached a high of over $50. So we're nowhere near right now the all-time high for this company. So once you look at the longer term chart, a 20-year chart, you can see the share price of this company has not moved from the bottom left to the top right. And there was a time here where there was a significant drop in the share price. In fact, the share price of Bluescope Steel dropped from about $50 or just above $50 all the way down to below $2 in 2012. Now onto the financial year results for this company. And before we have a look at the revenue, profit, operating cash flow, what is the valuation or the current valuation of this company right now at a share price of $16.14? Bluescope has a markup of $7.6 billion. Now onto the financial metrics for financial year 22. Revenue, $19 billion. Profit, $2.8 billion. So just have a look at that profit. Profit of $2.8 billion with a markup of $7.6 billion. So straight away, if you know how to calculate PE ratio, you can see this company has a very low PE ratio. And operating cash flow. So this company looks like it's bringing a lot of cash flow in their day-to-day business. So operating cash flow of $2.4 billion, and that does not include some leases, which wasn't that much. And the earnings per share for financial year 22 was $5.71. And again, if you know how to calculate PE ratio, you can just look at the share price, $16.14, earnings per share, $5.71, and you might say this company is looking really cheap because it has a really low PE ratio. One way we can determine the quality of a company is just by looking at the revenue growth of that company. And this is the revenue history for Bluescope going all the way back to 2007. So 15-year history of revenue. And from the period between 2008, and remember there was that massive drop in the share price from about 2008 to 2012. And you can see the revenue for this company actually dropped from over $10 billion to a low of $7.3 billion in 2013. And remember, the share price low for this company was in 2012. So the share price low was actually before the revenue low. But from 2013 all the way to now, the revenue has increased at a fairly consistent rate. So if you just looked at the last 10 years in history or revenue history, you might say that this company is high quality because revenue has increased from 7.3 billion to 19 billion. And just look at that revenue growth in the past year, increasing from 12.9 billion to 19.0 billion. And then if you calculate the revenue growth, annual revenue growth over the past 10 years, we see it's been growing at 8.2%, and it looks like revenue has been accelerating. Over the past 5 years, growing at 13.4%, over the last 3 years, growing at 18.3%. But the reason why it looks like it's accelerating is because of the revenue in the past year. And there is a reason why revenue grew or increased from 12.9 billion to 19.0 billion. And that's also the reason why the PE ratio looks really low. And we'll get into all those reasons during the rest of this video. Now onto the financial statements. Now, I'm not going to really look at the statement of cash flows. And another reason I have a little bit of a soft spot for Bluescope is because of the presentation and the information they provided in the presentation. Something like 70 pages. It seemed like it was really long. But they revealed a lot of that capital allocation decision-making strategies. And I really like those sort of that sort of information because, in my opinion, capital allocation is one of the most important decisions management of a company have to make. What do they do with the cash they're bringing in their day-to-day business? So on the right-hand side here, we have sort of a history of their cash on hand. So actually, this is net cash divided by debt. So the net cash has decreased from December 21. This is only half year. From December 21 to June 22, actually decreased from 696 million to 367 million. So why, if this company is highly operating cash flow, has a cash on hand or net cash actually decreased in the past 6 months? And this all comes back to capital allocation decisions the company has made in the past 6 months. Now, the cash inflow from operations in that 6-month period was $1.4 billion. So if they didn't spend any money on anything, they would have had over $2 billion in net cash. But they spent $475 million on dividends and buybacks. And don't forget, the capital allocation decisions a company has to make includes dividends, share buybacks, acquisitions, research and development, or capital expenditure for growth or maintenance, those sort of things. So they spent $475 million on dividends and buybacks. So share buybacks are a capital allocation decision. Now, whether a share buyback that Bluescope is doing right now is a good capital allocation decision, I'm unsure right now. I don't think it's the best use of the money right now because I don't consider that the shares of this company are undervalued. They might think it is, and if they do think it is, and it is, a share buyback is actually really good right now because you want to do a share buyback when the shares are undervalued, not when they're overvalued. They also spent $120 million on North Star expansion. That's one of their subsidiaries in the United States. $711 million on acquisition, coal coatings, and $259 million on other expenditures or other capital expenditures. So those are the reasons why, even though this company is generating a lot of cash flow in their business, the net cash actually dropped during the last 6 months. Now, I'll briefly go through the valuation, and because I consider this a low-quality company, I don't really care about the valuation metrics. So I'm just doing this for giggles because P ratio of 2.7, price to sales ratio 0.4 might be understandable for this type of company, and a price to operating cash flow of 3.2 looks ridiculously cheap. But I have learned over the past 15 years or so that when a low-quality company has really low valuation metrics like Bluescope has right now, that's not the time to buy. In fact, that would be the time to sell. If Bluescope still had really high valuation metrics, you might say it's now at the bottom of the cycle and that's the time to buy. So we are seeing really low valuation metrics in coal companies. And don't forget, coal prices have gone through the roof. We are potentially reaching the top of the cycle in coal right now. Maybe it has a fair bit to run, but I think we are moving towards the top of that cycle. So even though coal companies look ridiculously cheap right now, it may not be the best time to buy into those companies. I also did a reverse DCF. If you don't know what a reverse DCF is, just the rate of growth a company has to have to justify the current valuation. And for Bluescope to justify the current valuation, the operating cash flow has to grow or not grow, has to go backwards at 11.7% per year. In fact, it's not operating cash flow, it's actually free cash flow I used for this calculation. So possibly just based off this reverse DCF, based off the valuation metrics, potentially Bluescope Steel is at the top of the cycle. And when we look at the chart, the daily chart, you'll see the share price is in a downtrend. So I think the market knows this. I think the market does know that Bluescope Steel is potentially at the top of its cycle. Now on to a few slides that the company, Bluescope Steel, did provide in their presentation. And I've already mentioned that I really like their presentation because of the information they provided, gave a little bit more insight into the company about why they have performed really well over the past year, and also in regards to their strategies in the next 5 to 10 years. Now, in this particular slide, you get a sense on why the company had a really good financial year 22. And on the right here, we have the North Star EBITDA and also steel prices, which is the orange line. And steel prices absolutely went off a rocker during financial year 21 into the first half of financial year 22, increasing from 271 American dollars per ton up to 1,352 American dollars per ton. But steel prices are starting to pull back. And you can also see the EBITDA or the effect of high steel prices on North Star EBITDA. Back in the first half of 2021, EBITDA for North Star was only $75 million. That increased to $926 million because of increase in the steel prices. And now EBITDA is pulling back because steel prices are falling. The other thing they mentioned or shown on the left-hand side here is that volume haven't increased over the past 4 quarters. In fact, volume is going sideways. And I should just mention that that's relevant because that means that the increase in EBITDA is solely because of steel prices, not because of an increase in volume. Now, the reason I like this particular slide in their presentation, it compares the EBIT of the company between financial year 21 and financial year 22, and also compares on the right-hand side here, the first half of financial year 22 to the second half of financial year 22. So we can understand through this particular slide what caused the increase in EBIT, which is earnings before interest and taxation, or what probably caused the increase in profit and all that sort of jazz. So the main reason why there was a significant increase in EBIT from $1.7 billion to $3.8 billion in financial year 22 was because of domestic prices. $4.9 billion increase in EBIT because of higher domestic prices of steel. But there was also significant increases in raw material costs. So coal, iron ore, scrap and alloys, external steel feed. So that increase in raw material costs was $2.6 billion. So if there wasn't that increase in raw material costs, Bluescope Steel would have had an even better financial year 22, but it was still a really good financial year 22 because of steel prices. And then if we go to the right-hand side here, we can compare the first half of financial year 22 to the second half of financial year 22. And EBIT actually dropped from $2.2 billion to $1.6 billion. And during this half year, steel prices actually dropped. So instead of seeing a massive increase in domestic prices, we actually saw it drop. And not only did we see domestic prices of steel drop, there was also continuing increases in raw material costs. Not quite as large as what we saw in the full financial year, but still increasing costs in coal, iron ore, scrap and alloys, coating metals saw an increase in raw material costs of $508 million. So that's the reason why steel prices is a reason why this company had a really good financial year 22. And steel prices are dropping, and that's why the PE ratio right now is at 2.7, because steel prices are falling, which means the company won't have as good a financial year 23 if steel prices continue to drop and don't rise anymore. I've already mentioned that one of the reasons I liked Bluescope Steel's presentation is they had quite a few slides on capital allocation. And in my opinion, I'm going to say this again, capital allocation decisions are one of the most important decisions a company's management have to make. So I'm really happy they included these sort of slides in their presentation. So they're talking about recent investments on the left and future investment priorities. So this gives me a clue in regards to what management are thinking on how they can grow the value or shareholder value in regards to this company. So in the next or in the future, they expect to spend $750 million in growth capital expenditure, $150 million in climate, and $1 billion in sustaining. So capital expenditure can be broken down into growth and sustaining or maintenance. A lot of companies don't provide that sort of information. So you have to assume the percentage of capital expenditure used for growth compared to maintenance. And some of the ratios I've heard about is just assume it's 50-50. So in the case of Bluescope Steel, it's not quite 50-50. Growth 750 million, sustaining or maintenance 1 billion. But we can see again what they're spending that growth capital expenditure on. Port Kembla Pipe and Tube Mill, North Star debottlenecking, Bluescope Properties Group expansion, Australian metal coating capacity, and then for sustaining capital expenditure, Port Kembla blast furnace reline and upgrade. And then also on the right, far right, they're talking about where in the next 5 years they expect to spend that money on between financial year 23 and financial year 27. So I love when companies provide this sort of information in their presentation, because it gives me a good idea what management are thinking and their plans they have for the future. Now, the company also provided an outlook for the first half of financial year 23. And don't forget or remember that the Ebit in the first half of last year was well over $2 billion. And management expects Ebit for the first half of financial year 23 to be in the range of 800 to 900 million. So significantly lower than what we saw last year. And this is the reason, again, why the P ratio is 2.7, because the market and the company is expecting significantly lower profits in financial year 23. And we could actually see profit for, say, 75%. And if it falls 75%, the forward-looking P ratio might be above 10. It could be even above 15 or so. So the reason why EBIT is expected to drop so significantly is because of significantly lower Midwest US HRC steel spreads and weaker Asian HR steel spreads. So again, it's all about steel prices, and they've made a lot of assumptions. And I think for Bluescope Steel, they have to make a lot of assumptions when they're giving guidance. So these are the assumptions they've made in regards to this particular guidance. The US mini mill benchmark spreads to be $400 a ton lower in the second half of financial year 22. East Asian prices to be around about $590 a ton. 62% iron ore prices to be around $100 a ton. Index hard coking coal prices around about $240 a ton, and the exchange rate between Australia and America to be around about 70 cents. So more than likely, a lot of these assumptions are not going to be right. So their guidance could be significantly higher than what they realize, or significantly lower than what they realize. And this is a problem with these sort of companies. Management have a really hard time to forecast any sort of financials for the company, because they are price takers. They have no say on any of these assumptions that the company is making. Because I consider Bluescope Steel to be a low quality company, if I am thinking of taking a position in this company, it's going to be all around the share price and the chart and the sentiment. And this is the daily chart for the company over the past year, or just over a year, so we'll say 14 months, and the share price has been dropping. It's actually moved into a downtrend. Share price has dropped from $26 to around about $16 right now. So a nice little downtrend in the share price over the past year, and the share price is continuing to drop because of the decreasing steel prices, and because the company financial year 23 results are going to be significantly lower than the financial year 22 results if the assumptions hold true, or if steel prices remain to go down from here. That's all I have for this video looking at Bluescope and their financial year 22 results. Don't be fooled by the low P ratio. 2.7 P ratio does not mean Bluescope Steel is cheap at these prices. They benefited from significantly high steel prices, and steel prices are dropping, and more than likely their financial year 23 numbers are going to be significantly lower than the financial year 22 numbers. And if they're not, this company is really cheap. But that would be determined if they had a really good financial year 23 comparable to last year on steel prices. Steel prices have to increase significantly from where they are right now. So if you have any questions, any thoughts, any concerns, leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.